Hello, everyone, and welcome to our webinar, Financial Planning at Every Life Stage, What It Looks Like and Why It's Important. My name is Eric Danielson. I'm the Communications and Client Services Administrator for AFP. We will be recording this webinar and recording future webinars as well. We will have a Q&A session afterwards, and we will stop the recording before the Q&A. The video for this webinar will be posted on our website sometime within the next few days. So in order to make sure this runs smoothly, we have muted your mics until the end of the presentation. So if you have any questions during the presentation, please feel free to type them into the chat. As you can see on the screen, you just click the chat icon on the Zoom menu and it opens up the chat and you can just type in there. So once we're finished, we will unmute and allow people to ask questions along with answering any questions that were posted in the chat. Excuse me. If you do have any suggestions or ideas for future webinars, we encourage you to post them in the chat or send an email to any of us. So with that being said, I will hand things off to Nathan and Teri.
Great. Thank you, Eric. Well, to start off, our August webinar is entitled Financial Life Planning at Every Stage, What It Looks Like and Why It Is Important. And we do know that as people go through the financial planning process, different issues are presented along the way that may not be at other life stages. So there has to be a different approach to planning depending upon where one is at, what their concerns are, also what your desires are from a planning perspective.
So we found that there are three main life stages when it comes to financial planning: builder, manager, and preserver. So for our clients in the builder phase, that is typically for folks in their 30s. As they get into their late 40s, maybe even early 50s. Our second phase is the manager, and that is for folks who are in their late 40s, early 50s, up until retirement age. And then, of course, preservers would be those folks who are into retirement. But each phase has its own distinct financial planning goals and concerns. And we've listed a few of those. But overall, the builder is focused on building a foundation, setting that financial foundation, avoiding costly mistakes, getting organized, maximizing their employer benefits, things like that. The manager is making sure that they are on track with their goals, looking at the impact of cash flow, money in, money out, making sure with tax planning that they are as efficient as possible, both today and in the future. And then the preserver, making sure they have the peace of mind and security when it comes to their financial plan, looking at optimizing their Social Security benefits, withdrawal strategies, rates of withdrawal, things like that. So it is important to understand that there are distinct financial goals and concerns that go with each phase of this wealth lifespan.
Yeah, very true. The other thing we wanted to bring to your attention was how financial planning programs that are being used behind the scenes of crunching the numbers have evolved. And it used to be that we use Lotus or Excel to crunch the numbers. I actually did start at that point when we were using an Excel program. We have evolved today into using two different distinct programs out there. And one is called Goal Driven. The second is called Cash Flow Financial Planning. So different financial planning programs may offer one of these or both of these, depending upon the program that is being used. And that is important to know as far as what program is being used when you are going through a financial planning process. Some of these have pluses and they also have minuses. So to understand that would not be something that the average individual would know. The most utilized programs out there today are plans called NavaPlan, Money Guide Pro, eMoney, and Right Capital. We use eMoney and Right Capital. And the reason for that is because there are shortfalls and using just one particular program that is not doing certain calculations in the manner in which we feel they need to be done. Therefore, we might use another program for that particular client or purpose or need. And that is why most people will use one program out there, but it's why we will typically use two. So that's kind of unique right now out there. Most financial planning firms are going to use one. We have found that there is a need to use two different programs out there. And so knowing that some of these programs may only do goal-driven financial planning, and then others may offer both. So again, that's kind of knowing what program is behind the scenes that is being used to crunch your numbers is an important thing from a financial planning perspective.
So there are a handful of different areas, technical areas, when it comes to financial planning. There's cash flow, money in, money out, looking at net worth, taxes, insurance, investments, estate planning. It's important for financial advisors to communicate with other advisors, family members, with spouses. So there are a number of different technical areas within financial planning, but the key really is to understand that you are at the center of all of that. You, the client, are at the center of all of that. Understanding what makes you tick with your different values, beliefs, dreams, concerns, and passions. So it's important to remember that even in the midst of all these numbers, of all these different technical areas, how it connects back to you as we go throughout the financial planning process.
And that is why we have this slide in here called Connecting the Dots. We do realize that financial planning is not all about the numbers, and it is an understanding of connecting what your assets are in terms of the dollars, but then understanding what those true assets are behind those dollars that are so top of mind and important to you. Our clients have often told us that family, friends, community, health, value, these are the things that they need their plan to connect to. And so we want to use our dollars so that we can enjoy, support, and maintain those true assets that we can identify in our life to be there. We were talking to a client yesterday, and they said at this stage of life, the two most important things to them are health and family. It's come down to just simply two things. So it's important that we hear that. So we are making sure that their dollars are connecting to those goals and their values as much as possible.
Yeah. And that's why it's so important for us to ask that question and to understand from our clients what is important to you. Everyone has areas that are more important to them than other areas, and it is unique between each client, and that's why it's so important for us to spend the time to get to know our clients so that we can understand these areas and how they impact each individual financial plan, because it really is all about connecting each person's values to their financial goals and understanding that there is a direct connection between those two areas.
So Nathan had mentioned three primary areas when we talk about our wealth life. The first one being the builder. This one is focused for people in the ages usually around 30 to 40. It can go up beyond 40, maybe people in their 40s. What we do here is we focus on goal-driven financial planning here. Many times we see people wanting to build that initial foundation, and just as you are building a house, the most important thing in a house is the foundation. So we want to start out here getting it right. And this will typically include getting organized, understanding how you're organizing your records, maximizing your employer benefits. If we can pull from that first, before we say we need to add some other things into a picture, that just helps to make that stronger. We want to look at your cash flow versus your budget. And then also, what savings rate are you able to apply to this? Given the fact that you are naming certain goals or desires that you want to shoot for and achieve, we want to tie that back to a savings rate that would go towards that goal. We're also going to look at your insurance needs. And in this area, typically disability is one of the most important forms of insurance that people have. And a lot of people don't give it enough credence at this point, but it's the number one behind health insurance. Another area is looking at the investment overview and understanding in general what investing is all about, but defining a strategy as to how you want to invest your assets based upon a certain stated asset allocation. So that can overlay with your retirement plan, whether it's a 401k, 403b, IRA, whatever that may be, and it could even pertain to a taxable account or Roth IRA, and also a regular IRA. Estate planning is also one that many times people just haven't really looked at. So having the key documents in place here is what we're stressing to make sure that people have. And so we will address that with an attorney and provide names if people do not have an attorney so that they can get these documents in place.
And so one common goal that we help our clients in this category plan for is college, saving for college for their children. So for this particular client, their two children, Jack and Jill, are looking down the road to going to college. Jack is 3 years old. His sister Jill is a year old. But we're looking to the future here for Jack going to college. We can even specify specific colleges. In this case, Jack is just going to go down the road to OSU, the main campus here in Columbus. And so we are projecting out to the future, and mom and dad are saving very carefully for his college expenses. And so we can project that out into the future, and we can throw variables in there, like what if he does get grants and scholarships, and what if he is going to take some college loans out? What does that picture look like? And we can do that dynamic planning with our clients as they look down the road and prepare for these specific goals.
Yeah, so for in that illustration, they'd only given that number, they were planning at about 83% of coverage of that goal. So there are things that we can provide information on to shore that up and bring it to 100. Yeah. So another thing that we will work with some clients, depending upon where they're at, is the need for looking at their budgeting, how they are spending their money. Not everybody needs help in this area, but for the people that do, we can provide an overview that might be helpful for them in the sense of how they are spending their money, whether it's the ongoing expenses that are regular ongoing expenses, which is the renewal pot, or if it is a harvest pot, that is more the variable expenses that can throw a lot of people off as far as tracking, because they can just be very all over the board. But we want to try and get a sense of what that is and find a way to bring that in to their process so that they feel more in control of their spending. And then the third one is looking at the honey pot, and this is where you are saving your money, and this could be looking at the emergency fund, and then something we call capital accounts, where we're identifying certain things we want to be saving money for, whether it's short-term, intermediate, or long-term, designating an auto invest savings program towards each of these particular goals, so that you can feel as if you're achieving some of the things that you want to over this time. So again, this is kind of our concept, and we use it with people to help them through this process. And it can come into play at any stage, really. It doesn't have to be for younger people. Sometimes people moving from work to retirement need to revisit their spending and try and find a way that feels comfortable to them.
Mm-hmm. Yeah. So our second category are the managers, and those are folks in their 40s, can be in their 40s, up until about retirement age, which is typically in their 60s. So they are tracking towards their goals. So we're looking at a few different areas specifically for them. One of the big things that we're looking at is current and future sources of income and their expenses, both now and as they move into retirement, looking at what their savings rate is. As they head towards retirement. We understand that there is a greater emphasis at this point on tax planning and being as efficient as possible. We also understand that insurance needs will shift during this age or this category, the stage. It will typically shift from having a greater emphasis on disability insurance. And this is the time where we are going to really start to look at long-term care coverage and what that looks like in the future. We also understand that looking at asset allocation, that may change during this stage. We're also going to look at Roth conversions, and that goes back to tax planning and being as efficient as possible, not just today, but also in the future. And also looking at estate planning. This is the time where a lot of times children are moving from being kids to being young adults. And what does that mean, both for mom and dad in their estate planning, but also for the kids and their need to have some certain documents like a healthcare power of attorney in place as they move into college age and young adulthood. So there are just a number of different items, different areas that come up at this age that weren't there in the previous one. So understanding where they are and the different challenges is very important.
Mm-hmm. And this is why when we flip into this stage of life, we are flipping from goal-driven to cash flow planning. And this chart is starting to illustrate what that visually looks like. We're putting all together the information that we've asked the clients to provide to us so that we can be as accurate about stepping them into the future as possible. The chart on the left is looking at inflows as far as your income. So we're starting out with potentially earned income. And then this can be flipping at this stage of the game to projecting what Social Security, or if you have a state pension plan such as OPERS or STRS or SERS, what that is going to provide as far as an ongoing source of income, in addition to looking at the combination between Social Security and state pension plans. So that also is something that needs to be visited at this particular point. So the green line is looking at income, regardless of the source of that income. The red line is then looking at expenses, expected current expenses, and then projecting out into the future what those expenses might look like. The jagged part, the ups here, could also be expenses that are being identified for car replacement in the future, maybe large vacations that you might be taking together or as a family, or potentially buying a second home. So there's a lot of things that we can look at here to stress the plan to see if this really is going to work for a person to life expectancy. On the right, what we are looking at is your total assets and how they are looking in the plan in and of itself. And so as you can see in this visual, it looks like they are flat for a period of time. That could be for several different reasons. And then they look to be continuing to grow until maybe at the very end. So here again, we are projecting into the future to say, what might your assets look like, assuming a certain rate of return, assuming a certain rate of savings rate, in addition to how we are spending our money and pulling from this pot that we have established as far as overall investable assets.
Mm-hmm. Yeah, so this is where the rubber hits the road, and these are all the numbers behind the charts that we saw on the previous slide. And as you can see, there's a lot of information on here, but basically this is a look year by year up into retirement and then throughout retirement. So this is a look at income, money in, expenses, money out, and the impact that that has every single year on the total portfolio assets. And we are looking at this in depth year by year in the years leading up to and throughout retirement to see what impact changes to spending, changes to income will have on the overall retirement picture. And this is called straight line planning. So there are no good years, there are no bad years. This is just a way for us to project up to and throughout retirement for folks' cash flow.
Yeah. And I will say also, the number one question we get from people in this time frame is, how long will my money last? Am I going to be okay? It's the most important question, it seems, on people's mind. So this chart does help to give people a sense of, will it last? Are you going to be okay? Are you going to be better than okay? And there's going to be some issues related to taxes and the like coming at you, which again, there are things that we need to do to make changes there. But behind this, we're also going to do a probability study, which is called Monte Carlo, but it helps to stress the plan to say, what is the strength of this plan going forward, given what we see right now? And that is why it is important to look at this every year.
Mm-hmm. Yeah, a lot of information on here, a lot of different things that a chart like this will tell us.
Yeah. Another thing that we talked about when we were talking about this particular area, not that tax planning isn't important at every stage of your life, but we do get into a little bit more nitty gritty with people 50 and up, and looking at what changes are projected at this particular point in time. So when you have your taxes done, it is a look back as to how you did last year. That's a tax preparer. We used to do taxes, so we understand taxes. But what we are trying to do is look at what is happening right now with your tax situation and projecting it forward, so we don't run into some things that we're going to be surprised about down the road. And this is just a program that we use for a lot of our financial planning clients. It's a separate program from the financial planning program, but we throw information in here from your previous year's plan to look at what's different this year, given the new tax law changes that are in place for this particular year. And then we can even project that out maybe to the next year to get a little bit more in detail. So a lot of numbers here, not going to go into the detail here, but bottom line, it helps us to do better planning.
So our third stage here is the preserver, and those are typically folks in retirement, age 65 and up. And we understand that there are three phases to the preserver stage: the go-go years, the slow-go, and the no-go years. And needs and desires and plans tend to change as they go from one stage to the next. So one of the very important things that we look at in this stage is rate of withdrawal. How much money is coming out of your retirement savings each year? A good rule of thumb, and this is just a rule of thumb, is 4% annually, taking out 4% of your retirement savings annually. But knowing that number and knowing where you are is very important. And so that's something that we definitely help our clients understand. We also understand that insurance needs are changing in here. We're going to look at Medicare premiums, how your income taxes can affect your Medicare premiums. We're also going to discuss required minimum distributions and try to help our clients be as effective and efficient as possible with those required minimum distributions. Often for folks who don't necessarily need that money from their required minimum distributions to live off of or to pay for their everyday expenses, a lot of times they will utilize a QCD or a qualified charitable distribution, and that way it will have a positive impact on their income taxes. And then also looking at estate planning and legacy planning, leaving for charitable causes or passing on to the next generation. So these are just some of the main areas that we help folks in the preserver stage in their financial plan.
So we wanted to end with this visual. We do have a closing slide, but this is a visual that we have created in our office. You can see someone in a boat or a kayak at the very top. We call this retirement row. And even though we're starting at age 49, there are a lot of things that we have identified given different ages that we need to be aware of. And we do have to update this chart, by the way, for a few ages that have changed near the bottom. But bottom line, the goal is to try and ride through this river in the middle, row our boat, row your boat down the middle of this without having an alligator or a serpent or a stick or a big rock throw you off track. And different ages are critical to make certain decisions at, and that is why we've kind of put this visual in place so that people understand, wow, there's a lot of things coming at us from 49 on that could be very impactful from a financial planning perspective.
So in closing, experience counts. AFP has been here for over 25 years now, through many different environmental economic cycles. We've helped many people through their financial planning process. We understand that minor changes have a big impact when it comes to financial planning. And that's why we place a big emphasis on annual reviews and updating the financial plan every year, because we know that if a plan starts to get off track, the sooner you can catch it and the sooner you can make a correction, the better it is. We also understand and take a holistic approach when it comes to financial planning, understanding both the technical and the human side, and understanding how those two sides work together really helps our clients to have a complete financial plan. Also, I want to mention that we are fixed fee only, a fixed flat fee only, versus a very common method of assets under management, which is simply just a percentage of the overall money that a client has. We feel that it is best and most fair to utilize a fixed flat fee model. And so that is what we do.
Yeah. And it really takes into consideration the planning process and underweights any assets that one has, because just because somebody has a lot of assets doesn't mean that their plan is complex. And so therefore they should not be paying a higher fee just because they have more assets.
Yeah, absolutely.
So yes. Lovely disclaimer.
Yep.
Thank you.